Little known fact, Thomas has been with the company for just about anybody longer than even the founders. He started, while he was doing his doctorate at Brown, he was working 2 days a week for Quantopian. And so he has attained his PhD in computational neuroscience, and he does a lot of the work on our portfolio construction and how we're going to identify the good algos, which he's going to share with you today. So thank you for coming.
Yeah, thanks for coming. I'm really excited to talk about this research that we basically just completed and submitted to Institutional Investor Journal as for a special issue. And really, you guys are the first to hear about the results that we have, so it'll be really interesting to get you guys' thoughts. I've already been introduced. I also want to mention my co-authors, specifically Andrew Campbell has helped tremendously throughout that whole project, and Justin Lent and Jess Stouth, who were just on, of course, as well. Disclaimer. I want to start by telling a little story of one of our contest algorithms. And as you might know, we run a trading competition, a monthly trading competition on Quantopian, and you can submit your strategy with a 2-year backtest, and then we let it paper trade for a month, and we compute a score from the backtest and the out-of-sample performance, and then basically the winner every month gets an allocation of $100,000, and we let it run basically over 6 months, and you get to keep 100% of the profits. And the things we learned doing that have really been invaluable, and this is one of those where the backtest that was submitted to us had cumulative returns that looked like that. So in 2 years, basically, it turned a profit of 800%. That's like absolutely incredible, right? So it's a money printing machine, like never has a down month, and looks almost too good to be true, right? Then we deployed it to paper trading, 1 month of out of sample, and this is what that looked like. Maybe it's a little bit more volatile. It's still going up though, it's pretty good, and actually that triggered that entrant to win the competition that month. So we deployed 100K to it, and this is what happened. So many quant professionals probably will know plots that look exactly like that. The reality doesn't always match with what basically the backtest really promised. And that really triggered us to look much more closely into backtest overfitting. I mean, that's really the most likely explanation for what had happened here, right? So we did what every good researcher should do. We looked in the literature, and this is a paper that I specifically liked. It's by Bailey et al. And Marcos Lopez de Prado, who I think is also a really great scholar, who wrote it. It's called Pseudomathematics and Financial Charlatanism. Already there, you can see that like part of the paper is basically one long rant about academics and publishing papers that like promise amazing backtest performance, right? And then like the assumption is, well, those are all overfit and they don't perform out of sample. And often like it's not really tested, right? I mean, you just like submit a paper with like that strategy on historical returns, and they're really good, but no one really tests you on that. And I don't know, like some evidence is maybe like where all these billionaire academics that should have spawned. But the other part of the paper I thought was also really interesting, and they do a whole bunch of simulations that are set up like this. So the critical thing is all of the simulations they do all have a Sharpe ratio of 0. So the next few slides always assume that the strategy that we're going to look at has no edge whatsoever. So the expected returns are 0, and the expected Sharpe ratio is 0. So they generate a bunch of random walks in this manner, and some of them will look like that, right? So they go up in like that first half, and then they just walk about just due to noise, because again, the Sharpe ratio is 0. And what they then do is they split it in 2 periods and call one the in-sample, the backtesting period, and the other one the out-of-sample, the period where the quant presumably didn't have access to. I mean, this is just like a theoretical setup, right? But that's sort of the idea behind that. And then, of course, you can compute the Sharpe ratio of both of these periods and ask, like, how much did the backtest tell you about the out-of-sample performance? And it's not surprising that it doesn't tell you anything in this case, right? So the correlation between the in-sample Sharpe ratio and the out-of-sample Sharpe ratio is 0 by design, right? So that's just how we set up that experiment. And moreover, it is centered around 0, right? So because the random paths we generated have no edge, the expected Sharpe ratio in sample and out of sample are 0. But of course, there's a lot of noise, and some of those will have like amazing in-sample performance, and some of those will have terrible in-sample performance. But again, it doesn't tell you anything about the out-of-sample performance. So that's sort of what is really the generating process, but it's not really what is problematic and what's causing the problem in reality, which is the quant, right? I mean, imagine you're doing this and you're just running a whole bunch of backtests and gather all these results. And of course, no one is ever gonna like talk about or show like this side of the thing, right? They're gonna like look at the backtest over here with like a Sharpe ratio higher than 1 and get very excited and say, okay, well, this is, these are like really the key ideas that I should focus on and then deploy them. So like you can just zoom in basically on this very high area. So now we're here on high Sharpe ratios. But of course, again, due to the setup of the simulation, it doesn't tell you anything about the out-of-sample performance, and you're going to be very disappointed when you actually deploy capital to that. So they actually go on and test other assumptions in the modeling, one of them being, so you don't only have, in this manner, there's no correlation, but if you assume, for example, that there are things like global market constraints and overcrowded investments, you actually also can get results that look like this, where having a high in-sample Sharpe ratio actually is indicative of a negative out-of-sample Sharpe ratio, so a negative correlation. And I mean, these are just simulations, right? So it's not clear like which is true in reality. Then the last result from that paper that I wanted to show you is a theoretical consideration where on the x-axis you have the number of backtests that you run, and on the y-axis you have the expected maximum Sharpe ratio that you're going to get, again, with the true Sharpe ratio being 0, just due to noise. And this is over a 1-year period, so you can see with just basically 100 backtests, you are very likely to get a Sharpe ratio of 2.5. So that just goes to show how easy it really is to like create good-looking backtests that actually do not have any merit. So as you might know, theory and reality don't always match, and I learned that very early on. It's a very painful image for someone who loves burgers like me. So I immediately after reading that paper was like, well, that's really cool, but like it's all new simulations. Like, how does it look like in reality? And the key problem, of course, with trying to answer that question empirically is, well, where are you going to get that sort of data? Imagine like you have to have thousands of strategies, right? You have to have access to the full history, basically, of how it was developed. And again, like, I don't know, in an academic paper, no one ever tells you how many backtests they ran. I mean, they should, but they don't. They don't tell you, I don't know, you don't have access to like the same data that they use, so you can't replicate it in the first place. You can't, so that means you also can't like really test it one-to-one on the out-of-sample performance. So really, the setup is extremely difficult to try and do these, and just like having such a data set is very challenging. And then I realized, hey, wait a second, actually, I'm one of the very few people who has access to that data. So at Quantopian, we have over 70,000 users who have run over more than 3 million backtests, and these are all timestamped, which is critical, right? So the code is encrypted, we can't look at what it's doing, but we can look at its output. And we know basically when was the last time that the quant accessed that code. And that tells us, for example, if the last time like that code was edited on April 2014, we can rerun that strategy up until yesterday and basically have 2 years of actual out-of-sample performance that the quant couldn't have had access to just because it hadn't happened yet at that point. So that's what we did. And the other really important thing, as I mentioned before, is that it's a controlled environment. So we know exactly, basically, how many backtests were run. We know exactly what data the quant had access to, and can rerun it one-to-one. So like it's actually perfect conditions to like test the assumptions of that paper, and that's what we tried to do. So this is the data set we started with. Go ahead.
When you say you don't have access to it and it's encrypted, how are you then able to rerun it on out of sample data?
Yeah, so I mean, we run like many backtests, right? So like somewhere that code is being run, but like so somewhere it is being encrypted, just we don't have access to that. I mean, the machine has. But yeah, our terms of use are very explicit about that, and I don't have access to it. So over 7,000 strategies in our initial data set size, much smaller number already than the 3 million, right? And the reason is, well, there's like many things that are just not going to be interested in this context. So we try to make it extremely easy. You go to the website, and with just a single click, you run your first backtest, but that's not going to be of interest here, right? That's like, yeah, some example just like get people going. So really we need to like screen out for intent where people wanted to actually do something meaningful. So these are basically all the contest algorithms and all algorithms that people have deployed to pipette trading or live trading. And there's a lot of variance in these strategies, and I think that really adds value to the data set. We don't want to be constrained and biased to just like a single type of strategy. We want to like get a really wide view of different styles. And so here I'm just listing some of those different criteria that we find and that are in this data set. And critically, we filtered so that all strategies have at least 6 months of out of sample data, just to like reduce the variance. Like computing a Sharpe ratio over 1 month is not going to really be all that informative. So most of them are between 6 months and a year. People always say data science is 80% data cleaning and 20% interesting stuff. That is actually pretty accurate. And so we had to like do a lot of that and remove things like just cloned algorithms. We have a feature on the forum where like some people would share their code, and then you can, with a single click, basically just like copy that and rerun it by yourself. So that will introduce bias. So we filtered those out. We filtered outliers out with like, I don't know, a Sharpe ratio of 15 or minus 10. We filtered things out with single positions. That's also critical. A lot of those are just like buy and hold Apple strategies that are really like not. You got to try harder, basically, to do that. And correlation is also very important. So a lot of strategies are pretty correlated, maybe because they are cloned and then altered. But so that is sort of like has been difficult in delineating like when does it become its own strategy and when not. So there's a trade-off here between being overly restrictive in your filtering criteria and having enough data to sort of do this analysis. And this is what we ended up with, 888 algorithms, which is enough to like look at interesting things. Okay, so let's look at some results. The first thing that probably we're all wondering about is, well, how does the in-sample performance correlate with the out-of-sample performance, right? So the direct test of the Bailey et al. Paper. And before showing that, I want to get your own intuitions, basically, of what you think the correlation will be like. And I'm already going to tell you that the correlations that we're seeing are low. So like there's no huge effects, either like positive or negative. They're small, but still, the question is like, is there a positive correlation between the in-sample and the out-of-sample performance? Is it like completely flat or neutral? So who here thinks that it's a slight positive correlation between them? Okay. Who here thinks it's flat? Backtest doesn't tell you anything. Okay. And who here says it's negative? Okay, so it's actually pretty uniformly distributed. That's kind of interesting because, yeah, I mean, it really shows, well, we do need this data, right, to tell us what the answer is. And the surprising answer is that everyone here who raised their hand is correct. How can that be? So it's really a question of what you look at. So the first thing we could look at is annual returns, and that is in sample versus out of sample of those 888 strategies as are shown, and that is small but significant correlation, negative correlation between these two. And also you might note, so the x and y-axis are sort of interesting, where here it's like definitely on the positive range, and here it's around 0. So very similar actually to the Bailey's et al. Paper. And next, we looked at Sharpe ratio, and there we actually find a stronger positive correlation between the in and out of sample performance. That's kind of interesting, and I'll come back to that. Others we looked at were the information ratio, that's flat. The Sortino ratio is about as predictive as the Sharpe ratio to its out of sample equivalent. The Kalmar ratio is flat, and so is alpha. So that is, interesting. Ahead of time, I also didn't really know what to expect. And one thing I want to drill in deeper is this notion that some of you might be wondering now, like, so the Sharpe ratio is made up of mean returns over volatility, right? So if the mean returns and annualized returns, right, that's about the same. And so how can, like, basically this quantity be negative correlated and the quantity that is correlated, that is computed using this one, right, how can that be positive correlated? So that, like, was really puzzling to me. And the answer is kind of interesting. There's an interaction with volatility. So if you look at strategies with low volatility, less than 10%, you actually find positive correlations in both of these. And if you look at those with high volatility, it's slightly negative. So it seems that those strategies with low volatility actually are, those backtests with low volatility are more predictive of the out-of-sample performance than those with high volatility. And it might be that some users basically were maybe only maximizing annual returns and, like, not caring about the volatility that they're taking on, and that is apparently bad. But in general, it shows that, like, this type of data analysis really allows us to, like, compare also these different metrics. I mean, there's, like, so many metrics out there that have been suggested, and really now we can see, like, how useful are they really, right? We can pit them one against each other. Not performance related, but volatility and drawdown are actually very correlated, especially volatility. So you can trust a backtest's volatility and the drawdown actually as well, which is kind of relevant. And next, this is just to remind you of that previous result where we see, like, how easy it is to overfit a backtest if you run multiple ones. And we do have access to that, right? So we know how many backtests a quant has run. And that number itself, turns out, though, is not really what we want to look at in this case, just because a lot of times when people are working on code, they would just run a backtest over, like, 5 days just to, like, make sure their code is correct, right? So the absolute number is sort of irrelevant here. Instead, what we looked at is the total number of backtests that you have tested in the whole period you developed the strategy over. So that means, for example, if you ran 10 backtests with a 2-year window of a 2-year period, that'll be 20 years in this metric that we're going to look at. And because that's going to be very skewed, we log transformed it. The first thing we looked at is the number of backtest days versus the in-sample Sharpe ratio. And that is actually, I think, the most direct test of the Bailey et al. Prediction. Clearly, the more you backtest, the more the in-sample Sharpe ratio should be, but actually we don't find that. And that was surprising to me. Like, there I expected actually a really strong correlation. Go ahead.
Just because people stop. When they stop when they get to one, they submit it to move on to another out.
Yeah, that's a good idea. Yeah. Then we looked at the correlation to the out-of-sample Sharpe ratio. And there we find a negative correlation. So it doesn't really seem to be overly beneficial in the in sample, but it's actually detrimental in the out-of-sample. And another way to look at that also is to look at how different is the in-sample Sharpe ratio from the out-of-sample Sharpe ratio. So we're just subtracting the two, and we call that shortfall. And that is basically yes. Again, showing the more you backtest, the higher the difference between your in-sample and out-of-sample Sharpe ratio will be. This is just as an aside, but there's also many things that are like sort of just opinions, and like everyone believes them, what like a good strategy should be doing. Things like hedging and being beta neutral, or having a large universe to decrease volatility. So here we can again test these, and in this data set, that actually turns out to be the case. So we find that strategy with a high hedge ratio, so we just medium split them, so those that are hedged have lower volatility, and those with a higher trading universe, with a large trading universe, also have lower volatility. So that, and again, that like sort of interacts with the result of like predictability of Sharpe ratio that we looked at earlier. Some other things that we thought would work but didn't. We thought that turnover and number of trading decisions would really be informative in terms of overfitting, just because like if you have a strategy that is making a lot of decisions every day, right, versus something that like only allocates, I don't know, monthly, or just has a single decision, that would be much harder to overfit, but actually we don't find that, like there's no influence of that. But I think it's fair to say that overall we see pretty good support for like the Bailey et al. Simulations that sometimes like matches really well, especially like the Sharpe ratio being like so far to the right in the in sample and then sort of being around 0 in the out of sample. But also we find some differences where, like for example, with the overfitting, that didn't really come through in the in sample, but actually in the out of sample, we've seen that has been detrimental. So the academic in me could say, okay, that's fair. I can write a paper about that. But it's not really all that satisfying, right? So really at Quantopian, we want to know, like, well, we want to get as much out of these backtests as we can. And really what we've done so far is kind of, I mean, you might argue that it's not really expected to work all that well, right? So what we're doing is we just have linear univariate prediction of the out-of-sample performance, and that's the most simple thing you can really do. So we've already seen that there are like these patterns in our data, right? So for example, the Sharpe ratio turned out to be, and the annual returns turned out to be more predictive in low volatility than in high volatility regimes, right? And I just like found that by like digging through the data, but who knows what other patterns are in there and like higher order interactions. So what I did is train a machine learning classifier to sort of try and predict the out-of-sample Sharpe ratio and see whether that would do better, basically, at picking out the features than just me like manually testing these ideas. So the first step is feature engineering, and we came up with 58 features that try to paint as wide a picture of the backtest as possible. And they are based on like three sets of data. We have access to returns, positions, transactions, and some metadata like number of backtest days. And basically we just threw everything in there we could think of. So the annual returns are in there. Tail ratio, which will become important later. I actually haven't found that being used a lot in the literature, but it's actually, I think, a really good measure. It's the 95th percentile of the daily returns distribution divided by the 5th percentile, and essentially gives you a sense of which tail is heavier, the right tail or the left tail, and you definitely want the right tail to be positive, right? So if that's larger than 1, that's good. But also the Sharpe ratio of the whole backtest period, also the Sharpe ratio of just the last year, the minimum, the medium, the maximum of the rolling beta. So like all of those kind of things that you can think of. We have concentration, universe size, percent of profitable trade. So really everything we could think of, and we use Pifolio to compute most of these. So then we split the data into train and holdout, as you usually do in these types of settings, right? And all the results I'm reporting are on the 20% holdout split, right? So the classifier hasn't seen these before. Please.
Are you splitting temporally, or are you splitting across?
I'm splitting across, and that's a good question. Yeah.
So the trainer, the algorithm will have seen the future.
Yes. Yes. And that's a caveat. So yes, and then we're predicting to predict out of sample Sharpe ratio. Very quickly, so yeah, I used scikit-learn for most of this, and that worked well. We ended up using a random forest classifier, but there's sort of a sheer infinite amount of like machine learning pipelines you can test, and it's not really clear which of those work well, right? You have like, I don't know, do you do PCA, do you do ICA, do you do feature selection, or let the classifier figure that out, or which classifier do you use? Then you can like combine 8 different classifiers and feed the outputs into yet another classifier. If you look on Kaggle, like people do crazy things, and they do add something to your performance, but it's not clear which you do, and really there's no real other way than trying them all. And we collaborated with the guys from Data Robot, who are also a startup in Boston, on this, who have a platform where basically you upload your data and they just try like thousands of different combinations of classifiers and pre-processing steps, and just like try it all out and report the best way, the best ones there are. So that actually made this whole thing much faster. As I mentioned, we used a random forest. The way this works, just to give you a rough idea, if you know what a decision tree is, it's basically training many decision trees on subsets of your features and your data. So individual trees will be experts on certain features, and you like train hundreds of these trees, and then you average the result. And these just work pretty reliably and robustly in many data sets, and that's why they have been used so much, and they actually worked among the best in this case here as well. Okay, so if you recall, the best linear predictor was 0.02, which really basically of the out-of-sample Sharpe, or not the best linear predictor, but the in-sample Sharpe ratio had weak predictability on the out-of-sample Sharpe ratio, and the best data robot classifier, which turned out to be an extra trees regressor, which is very similar to random forest, that got us up to 0.17 on the holdout set, which is definitely much higher. And here you sort of see the lift chart, like how on average, sorted by the prediction, how close it was, the blue line to the green line to the predicted to the actual truth. It's really difficult to understand what these actually learning, just because they like learn in this 58-dimensional space and are nonlinear, right? So that is always a challenge. And in previous talks, I talk about Bayesian statistics, which have the benefit of like being much more hypothesis-driven, and you can really understand basically this. And in this case, we took a different route and just like wanted to see like how well can you do, and then I guess learning from that will be a second step. It's difficult, but like some easy things you can look at are, for example, what are the most important features that the classifier picked out? And the tail ratio that I mentioned before actually is the most informative feature in predicting out-of-sample performance. And that was really interesting. So the next step will be looking close at that. Also, the Sharpe ratio of last year is actually better than the Sharpe ratio of the full period. So that was also kind of relevant for us in practice. It's like, well, basically there's momentum or recency effect in that. The user backtest days came through, which we already knew ahead of time, basically that is predictive of like poor out-of-sample performance. And other things like the kurtosis, which tells you about like how heavy your tails are, and skewness, and the standard deviation of the Sharpe ratio, the standard deviation of the rolling Sharpe ratio. So if your Sharpe ratio over time like just trails all over the place, that's informative. And what's sort of interesting is that a lot of these are actually, so definitely tail ratio and kurtosis are informative about the tails, right? And I think in general that like mirrors the insight that like really the tail events are extremely meaningful. And a lot of times you look at the Sharpe ratio, right, and that just tries to describe the center of the distribution, which is really difficult to do and not all that informative. So I think one thing that this tells us is to really pay close attention to the tails. Now, again, I could have stopped there, but actually it's really interesting to see, well, how does this compare a portfolio that we select based on this to something to like say only selecting strategies based on the in-sample Sharpe ratio, right? So we're trying to like see whether this might be helpful for portfolio construction. And so we took the whole dot set and selected the 10 best strategies based on the predicted out-of-sample Sharpe ratio, the 10 best based on the in-sample Sharpe ratio to compare them, and then basically a whole bunch of random Monte Carlo simulations that just picked 10 strategies at random. And this is what it looks like. So in orange, we have the straw man with the in-sample Sharpe ratio, and in green, we have the other one. And here's just like the histogram view, basically, of the Sharpe ratio overall. So you see, like, this is, if you just do randomness, it's centered around 0, as you might expect. But these do seem to pick out a portfolio that does better than like most other ones that you can come up with, as well as the straw man. So some limitations that already have been mentioned. So one is you might argue that our user base, like this is basically only relevant for like the Quantopian user base. I don't think that's particularly a good argument just because, well, first of all, the number is pretty wide of like users, right? And we don't have like strong numbers about who these people are, but we have like a lot of like sort of knowledge just from talking to them and them posting on the forums. So really these are people from all kinds of different career paths. We have software engineers, astrophysicists, academics, we have quant professionals, so really like people from all over the place. So it is diverse, and I think that's what makes it so interesting. The more difficult caveat is the time period, and specifically the out of sample is not identical for all of them, but pretty overlapping still. So most of these strategies went out of sample from 2015 on, and as you know, like the second half of 2015 basically is where most of these went out of sample. And as you know, like there has been a lot of market turmoil, and the benchmark, the overall market basically hasn't been doing as well. So you might argue that that is actually what's driving the results, and I can't completely rule that out, but we did test that, for example, on beta neutral strategies, and the theory being, well, if you're not exposed to the market, then that should have less of an effect to your strategy, and the patterns do hold across that. But still, that's something that I'd like to look more into, and specifically like having the classifier basically also only have access to a certain time period. We didn't have enough out of sample to really do that, but as time goes on, we'll just collect more data, and we'll be able to do exactly that, which I think is a critical test. But also this matches with like what other industry insiders have told us. Once we like tell them our results, they're like, yes, that's exactly what we see. And also, there's some academic studies that try to look at like these published reports and follow it up with them that do show a similar pattern. I'll be at the Q&A in a second. So next I want to look at, well, already what I mentioned before, but also how well does that holder portfolio continue to perform? Like, is that actually, how well is that doing? And also, it's sort of still a bit academic, these results, right? Because when we make decisions, in like investment decisions, then as Justin and Jess already showed, like we don't look at only a backtest, right? We always require out of sample, and that's really critical. So what I like to do as well with more out of sample data is include some part of the out of sample in the like train the classifier on that as well, and then try to break the out of sample using that. And that I think will have much better accuracy and will also be much more interesting than for actual use in reality. But yeah, in general, I think this allows us to move away from like this very theory-driven research. Professor Derman already said that like in finance, it's not really all that important to like dive really deep with theory, right? And a lot of like traditionally, I think that has been done just because it was the only tool that was really available to us. But with these like more broader data sets, we can really do data science on these, right, and learn empirically from them and try to validate the theoretical results or find new ones that are really interesting. And that was sort of the first attempt at doing that. Looking forward, maybe what this also would allow to like do is if you look at just in general how like that whole business has been formed. We had asset allocation, allocating capital to traders who then invest in the stock market. Now we like have a lot of algorithmic trading going on where basically that part of the stack has been replaced. But even in like very quantitative hedge funds, the asset allocation is still being done largely on a discretionary basis. So I think being more quantitative has a lot of potential there. Not saying that like it should only be completely automated, but at least supplemented, where we go to a quantitative asset allocation and basically use something, some approaches that I alluded to automate some of that. So with that, I'd like to thank you for your attention.
Joe, I'm on number 3. We've got time for just a couple questions.
On the generalization question, another possibility is that there's correlations in the strategies still, and you're using a very high-dimensional model to model them. Have you looked at that risk?
Yep, I have, and that is one point I mentioned early on, is that we did filter for correlations, and that actually severely like reduces the classifier accuracy.
You said there was a tension there between having enough data to do it on and having a severe enough cutoff on the correlation.
Yep. So what we found is that at a certain point, basically, it stops mattering, basically. So once you reduce the correlations enough, we didn't find that like the classifiers reduced accuracy afterwards. Yeah. Like if you do it too much, then like you just don't have enough data to like do anything really. But like until we could test it, basically.
If someone wanted to use these factors as an objective function for evaluating our own testing, are these regression coefficients available?
Yeah, so actually I do plan on making as much of this available as I can from the data to like the individual analysis steps. So definitely stay tuned for that. And then, yeah, you can just extract them and I can send them to you. That's definitely.
So very interesting research. I think the question is that if you publish this, is there a concern that your users will overfit to your overfit detector?
Yeah, that's a great point. I think that is a valid concern. Like maybe we discovered that the Taylor issue works so well just because no one knows about it and like optimizes that, right? It's possible.
Last question.
Did you try to run a classifier only the 5 or 10 most important features, or do feature optimization?
Right. At one point I tried that. Not quite sure I can quite recall, but I think that like, yeah, I can't give you a number, but like, yeah, there's definitely like a cutoff where like it stops improving it. But that is
generalization doesn't increase with that.
Well, it does, right? But it's overfitting.
Sure.
So.
And finally, why we do? In this case, backtest at all. So if it's not predicting the future performance, as the R squares are somewhere in 0.1, so why we do that?
Why do like we
backtest? No, in general. So what we can do better, because these results tell me is that whatever we do is almost meaningless. I mean.
Yeah. Well, so I mean, that really is the what you might walk away with after the first half, right? Where we see like, well, yes, only looking at like these simple measures is not helpful. But like, I hope that like this machine learning like sort of is a proof of concept that there is information in there that you can extract. We just like have to be smart about it, and that I think really is the hope. But I mean, this does tell us more things as well in terms of like directing the community to like try and overfit less, and that I think will be important. Like I don't know, people doing more research and like less backtesting. I think that's one thing. But Lisa Borland this morning also had a couple of great ideas. I think of like how you can reduce overfitting. There's also like a bunch of literature on that, some with Marcos Lopez de Prado, where you take the amount of backtesting into account, like the deflated Sharpe ratio that like punishes you for that. I mean, now we can evaluate whether that actually would be helpful here. So yeah, these are, or yeah, exactly, bootstrapping. That's one of the approaches. That's one paper that he actually has, and we can test that here now. So we'll try that for sure.
Thank you, Thomas. Thank you all for the questions.
Thanks.